Hi, dreamers. Last week I talked to you about the fact that I'm looking for safe harbors. And so this week I'm going to cover a brand new fund that has a yield north of 12% that pays out every single month and actually de-risks your portfolio. Is that combination even possible? Well, I hope you're ready for me to take you on a journey and explain why this brand new fund is one I am officially adding to my portfolio. Are you ready? So let's take a look. So I wanted to start with this Seeking Alpha article, which I think is extremely good at laying out some of the challenges and the effects that we are about to experience over the next couple of years. And so you can see the title here, Brace for Volatility, 10-year yields are pricing stagflation. Oof, kind of scary. And so stay with me as I go through a little bit of complicated economic juggling, which if you can follow, you will correctly predict exactly what's going to happen on the stock market. So it's kind of important. And we'll fully explain the new 12% opportunity that I'll talk about right after this. And so here it talks about how the 10-year Treasury yields have been rising towards the 5% level. And really the question is, will the uptrend continue or start to moderate back down to 4? And essentially it talks about the fact that the Fed views the 10-year break-even yield as the market indicator of whether long-term inflation expectations are anchored or not. And that once the 10-year break-even yields cross the 2.5% level, the Fed gets alarmed that inflation expectations are getting de-anchored and it's forced to turn hawkish instead of dovish, which translation would mean increasing interest rates. And it goes on to say that the falling real yield signals a slowing economy, while the elevated and rising 10-year signals the risk of de-anchoring inflation expectations, and thus in summary suggests that the nominal 10-year is signaling stagflation. Ooh, and that, my friends, is an ugly word. And so if you want to learn more about stagflation, you can just Google it. And basically it means an economy that is a combination of high inflation, high unemployment, and slow economic growth. And that this is a challenging economic situation to get out of. And you can see some of the effects here. Rising costs, where bills and the cost of living increase, an economic downturn where people lose their jobs, and we start to enter recession. And so this article points out some of the key drivers of why we're heading in this direction. That essentially, the market is aware that Trump's policies are stagflationary, and that specifically, the market understood that Trump's policies could cause a recession, that mass deportations and tight immigration could cause a demand shock, as fewer people translate into fewer consumption, and also could translate into higher costs as employers struggle to fill those low-paying jobs. And in addition, the DOGE actions could cause a loss in government jobs, jobs related to government spending, and less government spending on different programs also slows growth. And at the same time, the market understood that Trump's policies could be inflationary. Specifically, the tariffs are inflationary. And in addition, the mass deportations could cause a labor shortage, which is also inflationary. And in addition, investors could start to buy bonds looking for safe harbors. And I think this is the net that's critical to understand. According to this author, my expectation is that the economic data will first start to reflect the recessionary data. Specifically, he's expecting the February labor market report to be weaker due to loss of government jobs, loss of immigrant-related jobs in construction and hospitality, for example, but that the inflationary data will not start to be reflected in the official economic data until May or June, assuming that most of the tariffs are implemented by April, but that the market will start to respond to the early survey data reflecting the effects of the new policies, at which point the 10-year could start to rise back towards the 5% level and likely above, and that the iShares Treasury bond, TLT, moves inversely to the 10-year yields. And this is where it gets complicated, because if the downtrend will continue as inflationary expectations rise and tariffs start to get implemented, the slowing economy could actually keep the price near current levels. So, are you fully confused? Well, let me decode in layman's speak. So let's focus on this TLT, which many of you have asked if I'm investing in. And so I've been thinking about this for a while. So TLT is the iShares 20+ year Treasury bond ETF. And if we take a look at the basket of holdings, you can see that it's almost acting like a giant bond ladder, where it holds a basket of different Treasury bonds at different weightings. And so if you look at the last 6 months, you can see that this basket of bonds has steadily decreased. And if we zoom out, you can actually see how the price of TLT was as high as in the 170s. But as of 2020, when the pandemic hit, it has slowly gone down in price to where it is now. And you can see this almost bottoming effect since the end of 2023. And the reason for that is that there's an inverse relationship between interest rates and bond prices. In other words, the Fed policy has a huge effect on the prices and yields of bonds. Because when the Fed increases federal fund rates, the price of existing bonds decreases. And it's important to know that the opposite happens when rates go down. And so the net is that it's better to buy bonds when interest rates are high. And so I take you back to this chart of TLT, where people that bought TLT in 2020 bought a bond fund when interest rates were low. And we all know that over the last 4 years, in order to try to ward off recession, the Fed has increased interest rates steadily in order to manage the economy after the pandemic. So now we're in this situation where if the article is right, then all of the new policies causing inflationary results will push TLT down a little bit further, as interest rates probably will be held constant to keep the inflation under control and might even rise a little bit in the back half of 2025, or at least that's my expectation. But with this already being on the low side, I think long term, it has room to rise. And the distribution for TLT is okay at 4.27% and with a 0.15% expense ratio. But maybe there's another way to play this. One would be looking at the options chain. And if you expect this to be relatively sideways for a while, you could conceivably do at-the-money calls and puts right around the share price in the near future. Or you could let someone else do that. And so, introducing Amplify's relatively new ETF, TLTP. So TLTP was only launched a few months ago at the end of October 2024. Because it's so new, it has just under $7 million in assets under management. The management fee is relatively low for these covered call derivative ETF types at 0.3%, which if you add all expenses together, ends up being 0.38%. And so the idea here is that the strategy targets annualized option premium income of 12% with the potential of additional US Treasury bond income. They write a weekly covered call option to help mitigate risk by providing additional income and is a simple, efficient entry into US Treasury, which if you've ever tried to own your own Treasury bond, you understand. And so you can see here, it is a monthly payer with a distribution rate of 12.13%, and their strategy is selling 1 week expiration at the money call option contracts, which if you've followed what I've been saying throughout this video, you can see how at the money call contracts will likely be a winnable strategy for a while, especially if we enter a longer-term stagflation period. And so if we click on the holdings as of February 18th, 2025, you can see 47,000 shares of TLT with a market value of about $4 million, a straight US Treasury bond with a value of about $2 million. And here you can see the call expiring 2021 at a strike price of 89.5. which is pretty close to the $89.16 price that TLT is currently at. And so I would argue if you zoom out to TLT, that holding something like TLTP which has the underlying asset of TLT and an at-the-money call strategy on top of it, you'll likely have short-term, potentially a slight decrease in pricing as the interest rates stay flat and potentially increase slightly. But that longer term, interest rates will likely decrease over the next, say, 5 or even 10 years. And while you wait for this increase, you're able to capture that juicy 12% monthly payout. And that potentially in an era of stagflation, where inflation goes up, unemployment goes up, and economic growth goes down, garnering a sideways return of 12% will be a welcome addition and safe harbor. And so I'll leave you with this. What are some of the other safe harbors and areas that might perform okay during a recession? Well, it tends to be things like consumer staples that people cannot live without, like food and personal care items. Healthcare is also something that people really cannot turn off, and things like utilities, power, water, etc. And so I'll leave you with this. While you never want to over-rotate, because especially in an administration like we have now, things could turn on a dime. It's very unpredictable. You do want to make sure that you continue to think about a diversified approach, where if we do have a crash or even a long-term float down, that you are continuing to make progress against your financial goals. And so as usual, I hope this was helpful for you as you continue to think about optimizing your returns over the next 2, 5, 10, or even 20 years. Let me know what you think in the comments. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.